Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I tell you what's been going on in investment markets and what to look out for in the days and weeks ahead. So we've had a nice couple of week break since the last episode, and it's given us time to take stock of what's going on. And in fact, if we look at it, the market seems to be trying to send a message. If you imagine those old episodes of Lassie where Lassie started running up to somebody barking and they were like, "What's that, Lassie? Someone's fallen down the well." Well, it's kind of like that with markets at the moment. We're trying to work out what's just noise and what is something we should be listening to. So if we now look at where markets are at the moment, there's some great charts you can pull up yourself if you've got apps on your iPhone or smartphone. So look at your stock market app and go and look at some of the wider indices and look what they've done over the last couple of weeks. So since the end of June, if you look at the main stock markets, you will notice there's a pattern. So the Nasdaq 100 is up about 2.3% so far in July. So that's in a 2-week period. Compare that to the German DAX. It's 1.2% for the German DAX. European stocks broadly up 1%. If you look at the all world index from MSCI, then that's up about 0.6%. The Dow Jones is broadly flat. Then you've got the FTSE, which is down 0.48%. And then you've got emerging markets down around 2%, along with Asian equities. So you can see there's a real divergence that's occurred over the last couple of weeks. And if you delve deeper, then you'll notice some other interesting things that are going on in markets. For example, if you look at bank stocks, so that's XLF if you put that into your stock app on your smartphone. That is an ETF that tracks the financial stocks in the S&P 500. Compare that to XLK, which looks at the tech stocks, then you'll see that big tech stocks are outperforming the wider market, in particular financials at the moment. If you recall, the reflation trade so far this year had been about financials and those cyclical sectors, those things that would do well in rising interest rate environments, actually outperforming things that normally do poorly in a rising interest rate environment, which the latter group includes tech stocks and growth stocks. Then what we'd seen year to date was that financials were outperforming. But what we've seen since the Fed meeting back in June is that we've seen the large tech stocks outperform financials. And it was interesting because this week was the start of earnings week. So where companies start giving their results for the previous quarter. And we saw bank stocks leading the charge in the US. So they're the first companies that tend to report. And so far their results have been okay. They've not necessarily beaten expectations, but we haven't seen bank stocks kick on. So for those investing in funds or ETFs that favour those value sectors, bank stocks in this instance, then they might be thinking, well, what's going to be the catalyst to push them higher? If we move on and we look at the broader growth indices, so MSCI growth index that looks at the global growth stocks, that is still performing strongly. If you compare that to value, then again, it's been outperforming since that Fed meeting in June. In the last week or so, both value and growth stocks have started to flatline at the same rate, to be honest. So the broader market at the end of June started to all rise. That was growth and value, pretty much no matter what you bought, started to go up, particularly in the US. But now in the last couple of weeks, we're seeing that they've started to flatline, but growth stocks still slightly outperforming value. So that is another trend to note. So if you remember last time I was talking about how European stocks have been doing quite well when you compare them to their US compatriots. If you look at the IBEX, so IBEX, if you want to put that into your stock app, compare the performance of that versus the German DAX. So if you want to find that index, then you put GDAXI into your stock app on your phone and you should find it. Compare the performance year to date of the two indices. You'll notice that they've pretty much moved in lockstep all the way until we got to the middle of June. So pretty much in the last few weeks that broke. And what we saw was the IBEX starting to fall and the German DAX continue to rise. And that is an interesting thing to note. So what's going on there? And it starts to raise questions as to what could make the German DAX continue higher, but then the Spanish IBEX to fall. One possibility could be that with the reopening trade now looking to be questioned, then perhaps it's an indication of concern over rising COVID numbers that we're getting. Because in the UK, Obviously, Spain is one of the most popular travel destinations for holidays, but with those destinations being put on amber, red lists, etc., causing a lot of confusion for tourists, it means that the Spanish economy is likely to suffer. So how long could that carry on? If that is what's going on there, where we're seeing the stock market in Spain starting to take a little bit of a hit, partly because of concerns around COVID and this reopening of global economies, is that an early sign? And how long can that continue without it having a wider impact on the rest of global markets, including the German DAX? I mean, in the last couple of weeks, we've also had the Fed minutes, the minutes from the meeting that caused so much of the change in equity markets and bond markets in the last month. And people were looking at those minutes, wondering if it's going to cause any other upset or change in the sort of backdrop for investors. And it didn't. That largely passed without any major impact. But if we now look at other sectors that are starting to do well, then real estate, if you look at XLRE, so real estates, REITs, they are starting to perform well. So if you think about it, these kind of equities have exposure to the real estate market and can derive some of their value from the yield they can offer. In a world where interest rates are rising, then they aren't particularly attractive. So what we're seeing is that these REITs are outperforming. Then in a world where we're seeing yields fall and the idea that interest rates won't necessarily be put up by central banks, they're becoming more attractive. And talking about yields, if we look at the 10-year US Treasury yield over the last couple of weeks, we were up around about 1.45%, but then we saw a rapid repricing, a demand for bonds. So people started buying bonds, and it caused the 10-year US Treasury yield to crash down to 1.25%, which was about a 4-month low. That was a big move. And then we saw a bit of a rebound from the 200-day moving average on the 10-year US Treasury yield. But this demand for bonds and the fall in yield, therefore, started to make equity markets sit up and pay attention. And that's why REITs started to do better. It was one of the reasons as well gold has rebounded. It had a sharp sell-off, but it broke below $1,800 per ounce. It's now back above that, and it's looking like it could try and push higher, particularly towards that 1850 level, which would be key if it's going to keep moving above that. So if you pull that together with the idea that tech is outperforming, financials are struggling somewhat, we're seeing treasury yields pull back, we're seeing REITs do well, we're seeing gold having another lease of life. All of this starts to add up to perhaps a message that markets are telling us, and that is that they believe that inflation is indeed transitory and it's going to be a short-lived thing. If you look at some of the financial data that's come out, we've been surprised by the level of inflation, not just in the UK but in the US in the last couple of days. But the market is still pricing in the fact that the Fed and the Bank of England will take action, or that just the inflation won't run away with itself. Should that prove the case, and inflation does in fact run away with itself and push higher, that could be a shock to markets. And if the banks are forced to raise rates aggressively, that will obviously cause markets to reprice, and we're likely to see some sort of sell-off in equity markets. But it could also be a sign, all of these moves that I've been mentioning, that the market is looking at us moving into this world of slowing growth. So we've had the rebound from the pandemic, but that we're going to start to see growth slow. And again, if we don't see that, then we could see a rapid repricing of markets. There are elements of what we see in markets in the moment that are quite reminiscent of what we saw around the COVID crash last year. So that's bonds starting to be bought, that's growth stocks starting to outperform once again, some of the cyclicals starting to take a bit of a breather, but there are other parts that don't quite match. So the VIX, which people call the fear index, is not showing particular signs of stress. It's still below its long-term average. So there are still some mixed messages. Like I said, it's a bit like Lassie. There's lots of noise going on, but there definitely seems the market isn't quite buying what it did a few months ago, where the growth was surging, inflation was rising, the reopening of global economies was going to go without a hitch. Now the market is trying to work out what's going to happen next in terms of the macro backdrop, but also in markets. And if we look at the indices just at a broader level just before we finish, the S&P 500 is pushing up towards that 4,400 level. Keep an eye on that, because from a technical analysis perspective, the 4,400 level is going to be key. If you're into Fibonacci extensions, it basically, if you look at the fall from the COVID sell-off and use technical analysis, that suggests that the upside high point, at least in the short term, is going to be that 4,400 level, and the market's going to perhaps struggle to break through that. If it does, then obviously that would set up for a much bigger move higher. So we do feel like US equity markets are trying to work out what's going on. The narrative is almost changing day by day. And as investors, you're perhaps looking at your portfolio, wondering what is happening, where the next trend's going to come from. That is perhaps reflective of the wider market in general. So the big things to watch in the coming days and weeks are the stories around COVID, earnings numbers that are coming out at the moment, but in particular, pay attention to the 10-year US Treasury yield, because that seems to be driving a lot of what's going on in markets, and equity markets and investors are reacting to moves higher and lower in that particular benchmark. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email. Damien at moneytothemasses.com is the email address. Twitter, moneytothemasses with a number 2. You can find us on Instagram. You can find us on Facebook. And of course, don't forget to subscribe to our YouTube.